You've probably heard that the HDB loan is the safe, stable and government-backed. So most people just take it without thinking twice. But here's the catch. Once you sign, you could be stuck with a 25-year loan that might not actually be right for you. Should you take the full HDB loan or go smaller? Should you hold back some CPF? What if you want to refinance later? Hi, I'm Caleb. I'm a property agent in Singapore and I make videos to help you make smarter real estate decisions. In this video, I'll break down everything you need to know about HDB loans. Who qualifies, how much you can borrow, common misconceptions, and some traps I've seen clients fall into. By the end, you will know whether an HDB loan truly makes sense for you. Don't take the HDB loan until you understand the whole picture behind it. So who qualifies for HDB loan? First, you need to be a Singaporean citizen. If you are a PR, you definitely are not allowed also. And all core family nucleus in the house must not have taken more than two HDB loans. Like for example, if you add your parents in as the occupier, they must not have taken two HDB loans itself. Okay, but if let's say if it is new husband and wife, they have never taken a HDB loan before, they are eligible. So income ceiling will depend on the monthly household income. So for 14,000 is for families. If it's extended families, it'll be 21,000, and if it's for single, 7,000. So it means that if you have crossed above this particular income ceiling, you're not eligible to take HDB loan anymore. So the only option for you to consider next would be bank loan. These are the conditions you need to fulfill before you are able to take this HDB loan. Is that if you have a overseas private property or local private property, you must have sold away for the last 30 months. Then you are able to apply for HDB loan. You cannot own more than one non-residential property such as shop or office or industrial. One is allowed, but more than one you must sell all of it until left one, then wait for 30 months before you are able to apply for HDB loan. In terms of CPF usage, you must use all the remaining CPF usage to pay for the flat purchase, or you can retain up to 20,000 in each applicant's CPF OA. So, and of course, the CPF OA can be used to pay for your stamp fees, registration fees, legal fees, and CPF home protections. However, for occupiers, you are not able to use your CPF OA to pay for it. So some people want to use the owner-occupier scheme, whereby they put the owner as the husband as the owner and the wife as the occupier. In such scenario, the wife are not able to use their CPF to pay for the house at all. Next, it's the flat lease requirements and loan limit. So if you're buying a house that covers you until age 95 and above, your loan tenure will be 25 years or whichever that is shorter. Imagine today you are a 55-year-old person, you only can get 10 years. How do I say that? It's 65 minus age, which is 55 years old, you only can get 10 years loan tenure only. So all remaining lease less than minus away 20 years. Meaning to say that if let's say for example today you buy a 30 years property only, 30 years property, so and you are 45 years old, so you'll be remaining lease 30 minus away 20, you only can get 10 years of loan tenure. So whichever is shorter, when you compare these three at the end of the day, when you compare these three, whichever is shorter, that's the loan tenure of the loan for HDB loan. How much can you borrow at the end of the day? So you only can borrow up to 75% of the purchase price or flat value. So how the loan example will work? So for example, today you purchase a property at 500k and you use your CPF OA of 100k and your grant you have 100k as well. So the remaining 300k you can take loan for it. Why is it so? 300k divided by 500k is 60%. So it's definitely less than this limit of 75%, because 75% max is 375. So you take 300k is allowed. So you can borrow 300k because no cash top up is needed in such a scenario. Is cash needed when you take a HDB loan? On some circumstances, yes. So are there certain circumstances where cash is needed for HDB loan? Yes, most of the time you still need to pay cash for the deposit, the 1k and 5k itself. So assuming you have a purchase price of 500k and your CPF right now is 50k only, and then you are left over with 450k. So your max loan will be 75% of the 500k, which gives you about 375k. So in this case, your cash needed that you need to come out with is 75k. If you found this helpful, give the video a like, and it really helps more people discover this info. So what is the interest rate for HDB loan? HDB, there is a concessionary interest rate which is at 2.6%. So how do they determine it? It's actually fixed at 0.1% above CPF OA rate. So once your CPF OA rate increase more than 2.5, actually your HDB loan will also increase. But we have not seen it increase for quite some time as well. So that's why your HDB loan, people feel that it's fixed because of this scenario. But once CPF interest increase to 2.6, then that might tell a different story. So, and it's reviewed every quarterly as well. So if you are taking a second HDB loan, so just now in the case, if you are taking a first HDB loan, now we'll talk about second HDB loan, especially if you have already previously sold a property that took the first HDB loan, now you're taking the second one. So you must use your full CPF refund for it and 50% of the cash proceeds. Later I'll have an example for you and you can see how it is. And you can retain up to about 20,000 in your CPF OA as well. And if you buy before selling, you will be charged interest at the market rate, which is not concessionary. Usually it's about 3.5%, and eventually will be converted back to 2.6% only after you sell the property, sell the HDB, and you use the CPF refund plus 50% proceeds to repay the loan. So let's go into an example right now. For example, you sold a HDB before and you're using the first HDB loan, that was it, and now you take up a second HDB loan. And the sale price was 500,000 for the first HDB that you take up. The loan was 200k outstanding loan. The CPF used was 100k. So cash proceeds is about 200k. So your second HDB loans must use all your 100k that is being refunded, and you must use 100k cash, which is from this cash proceed, to reduce the loan amount given to you. So this 200k that you have here must be used for the next property for your second HDB loan. Why HDB has this rule is so that you guys will not be over leveraged and will not use the cash proceeds that you have to anyhow spend money and stuff like that, to help you to remain prudent. Basically, that's their principle behind it. So how to find out how much loan you can get? Do a HFE. That's one thing, one way. A HFE letter informs you of a few things. First is your eligibility to buy a new flat. Second, how much grant you can get. And third is take up how much loan you can give you also. That's a HFE. So HDB will assess your income. Typically, they will take 30% of your income to calculate the loan amount. So how do you estimate it on your own if you really want to estimate? So you need to first determine your age. So how old are you? If you're 35, so 65 minus away 35, then that is 30 years. But maximum, I told you, only can get 25 years loan. So if you're a couple, let's say 50 years old and 55 years old, the average age is about 52. So 65 minus 52 will be about 13 years old. 13 years. So that will be the loan tenure. So determine the loan tenure. 65 minus age, max 25. So if your age is 45 years old, so it'll be 65 minus 45 will be 20 years. So that is the loan tenure. Then next, you determine the combined income for owners. So based on the two owners or one owner, you calculate what is the combined income. So that, let's say, it's 10k. Then you determine what is 30% of the total income. 10k times 30%, that will be 3k. So next, we'll use a financial calculator. Let's run through this together, then I can show you how it is. Financial calculator, you can use this TVM calculator. Then after that, you can put in payment 3,000. Then interest rate, you put here 3%. And then this period, it's based on how many years it is. If it is 25, then 25 times 12, 300. So 300. So you click on this present value. So present value will be 632. So this 632 will be the loan amount that you can get. Okay, this will be a rough estimate of how much loan you can get even before talking to HDB. Of course, this one has to be basing on you have good credit rating and good never owe money to other people and stuff like that also. And if you want more no fluff property advice, like this and hit subscribe so you don't miss the next one. So for HDB loan, can you pay off early at the end of the day? Yes, there is no penalty in paying off early the more you pay, the faster it is, the lesser interest you will pay at the end of the day. Because remember, you are paying 2.6% annually for interest. So, but please do not use your CPF OA to pay for it, because there is still a accrued interest element you need to pay eventually when you sell the house. So best to use cash to pay for it at the end of the day. So right now we come to which is better for you, HDB loan or bank loan? Which one is right for you? So the difference actually is the interest rate. Interest rate usually for HDB loan is fixed, but bank loan, it can fluctuate. Back in 2021, it has increased significantly such that HDB interest, the bank loan interest could go up to 3.5 to even 4% on some circumstances. Another thing is why a lot of people choose HDB loan is because bank loan, you need to pay down a 5% cash down payment, which some people might not have it. Then they must go for the HDB loan. And why people choose HDB bank loan sometimes is really bo pian, because the thing is that their income ceiling exceeded and then they are not eligible to take a HDB loan anymore. So HDB loan, there's no early repayment penalty. Bank loan, there is penalty applied if you are within the lock-in period. And for HDB, there is more, generally the flexibility is more lenient, but for bank loan, it's more stricter. And also another thing is cost-wise. If you apply for bank loan, you need to pay private legal lawyer fee, which is about $2,000, which is quite expensive when you buy a HDB compared to HDB loan. The legal fee is about $500-600 only. So can I switch to bank loan if you decide to from a HDB loan? Yes, you can refinance your HDB loan to other bank loan as well. The refinancing process is very straightforward. You get a loan approval from the banks, then you go to a lawyer to accept the letter of offer, and then HDB will issue a loan redemption statement and your lawyer will settle everything for you. Within 8 weeks of the application, you'll be there to your bank loan already. So can you U-turn to HDB loan from bank loan? I'm sorry, once you refinance out, you cannot return to HDB loan anymore at the end of the day. Let me know in the comments, are you leaning towards an HDB loan or bank loan? And comment why. So what are some of the misconceptions about HDB loan? Is HDB loan always the best? If you have strong cash flow or plan to repay faster, bank loans usually will have a lower interest rate. But of course, like what I mentioned to you, bank loans interest fluctuates based on what the Federal Reserve mentioned. If Federal Reserve wants to increase the interest, Singapore's bank loan interest will also increase as well. So, but downside is bank loan interest will fluctuate, which I mentioned. Another misconception is HDB loan is free money. It's not free money. You're still paying 2.6% interest compounded monthly. It adds up over time, over 25 years. So imagine you take up a 500k loan and you pay over 25 years, 2.6%, total interest you'll be paying is 180,000. So you still need to pay interest over the 25 years as well. So another misconception is that I must use all my CPF. Generally, you don't need to use all your CPF. You can keep up to 20k in your CPF per person. So, and it's great for emergency. Some people employ this method where they do CPF parking. So they invest their CPF OA into low risk instrument. Then they go and buy a property or buy a HDB. And after buying a property, they sell the investment and money comes back into the CPF. So that's another method also, but I wouldn't advise on that as well. Another thing is that should you take a full loan or partial loan? It really depends on what you know whether to do with your cash and CPF. Because some people are able to invest at a higher return to produce a higher growth. Like for example, they invest in the S&P 500 and grow at 7 to 10%. In such scenario, take the full loan and use the rest of cash and CPF to invest as much as possible if you want to. But if you're risk adverse, take a partial loan, reduce the interest paid and reduce the monthly installment as well. Okay, that's two sides of the coin. Both is right. There's no right, no wrong at the end of the day. Then should you pay part cash monthly instead of 100% by CPF? Yes, if you can afford to, because paying with cash helps your CPF to compound 2.5% annually. So that's another interest that you're getting as well. But if you pay with CPF, it's 2.5% opportunity cost gone. So useful for retirement or future investment also. So it also helps to reduce the CPF accrued interest payable, which I mentioned as well. So another thing is that should you reduce your loan tenure over time? So it really depends again. If you know what to do with your cash and CPF, like for example investing in CPF, you can take a longer loan tenure and invest the difference, because the longer loan tenure is, the smaller the monthly installment. When the smaller monthly installment, you can take the difference to invest if you want to. It's kind of like a cheap long-term loan basically, because the cost of borrowing is 2.6% only. When you compare to other outside personal loan, it's a lot higher. So if you're risk averse, shorten the loan can help to reduce the total interest payable. So both sides of the coin, no right, no wrong at the end of the day. So another thing is that, should I refinance later? If market rates are good, lower than 2.6%, yes. But remember, once you leave a HDB loan, you cannot come back, because once the Federal Reserve increase, you'll also be bearing the brunt of increase as well. So and you only refinance if you set aside enough buffer for your rainy day or rainy month or rainy years, or if you choose to become a self-employed, that's another thing as well. So final verdict, should you take a HDB loan? Take a HDB loan if you prefer stability and peace of mind and you have limited cash, because bank loan you need 5% cash and you want to use more of your CPF, and you want the flexibility to repay early anytime, and you stretch your loan tenure for lower monthly installment as well, 25 years and stuff like that. You're not confident with the market interest, because if Federal Reserve increase the interest rate, you don't want to be scared by this increase in interest rate, then taking a HDB loan makes sense as well. Another thing is that if your loan size is small, less than 300k, the cost and effort of refinancing to a bank loan later on is not worth it at all, because if you refinance, there is cost you need to pay to legal fee, valuation fees, and so on and so forth. So if it's less than 300k, it's better just stick to a HDB loan also, and eventually do a full payment when you are done. Consider bank loan if you have strong stable income and you're not eligible for HDB loan. So not eligible for HDB loan, just go and take a bank loan also. 5 years ago, I would say that if you want to save on interest costs, go with a bank loan which is lower than 2.6%. However, bank loans face the brunt of Federal Reserve increase, which is not good, because I experienced it myself as well. So I hope this helps. Now that you understand how HDB loans work, the next step is knowing how to actually buy your resale flat the right way. In the next video, I'll walk you through everything from HFE to finances to grants and even the temporary extension of stay. Click here to get the full video roadmap right now.